Hello everyone, welcome back here. Let's talk about debt, its types, how to use it, and when you should be taking debt and why people need debt. Whenever we talk about debt, there are two thoughts or two kind of person will think about debt. First one, it's bad. You should not be taking debt. It's bad for you, for your children, for your future. It will just put you in an infinite cycle of borrowing more money if you take debt. Or the second thought, it's free money. You can use credit cards, your line of credit, you can get the mortgage, the highest possible mortgage, and buy the biggest house you can, and you don't need to pay it back. It's wrong. Both thoughts regarding debt are wrong. Let's start with the type of debt. First of all, we can categorize under credit cards, line of credit, short-term loans, loan for your car, loan for your sofa, furniture, or hot water tank, or any kind of thing which is short term, or your mortgage. I will go in depth for all these four categories, but let's start with, before you take debt, there are 3 or 4 points which you should consider. Why you need it? Do you really need it? And what's the cost of borrowing? What's the rate of interest? What are the repayment plans? Is there any penalty to pay it back early? Like a fixed term mortgage where there's a penalty to repay it back before the term. And what's your limit? I have also posted a link from the Canadian government website where you can go and see what are the different kind of credit cards available, and it also provides brief knowledge regarding different kind of financial or financing things. I will post that link below the video, so please go there and have a look. Let's discuss common type of debt or the 4 major sources of debt that you can see in the marketplace. The first one is the credit card. There are different kind of credit cards which are offered by banks, lenders, or the retail stores. These are MasterCard or Visa credit card or other type of credit cards. And before you get into a credit card, there are 3 or 4 things that you should consider, like what's your limit, what's the rate of interest, what's your payback time, so that you don't pay any kind of interest. Payback time, normally the credit card companies will give you 21 days to use the credit card and pay back, and so that you don't pay any kind of interest on that. And what are your loan terms, conditions, what you can purchase or cannot purchase using the credit card. And there are some kind of credit cards which offer you benefits, like the cashback credit cards or the point credit cards, or where you can just link your credit card with a gas station, Petro Canada or Shell or other kind of gas agencies, where you can just get some points and redeem those later. There are some credit cards which offer you aero miles, which you can use to book a airline ticket depending on how much balance you have, with how much balance of points you have. And some credit cards offer you a yearly fee, let's say $120, $60, or other kind of fee, or some are no annual fee. No annual fee credit card. I like the no annual fee credit cards, but sometimes I just go with the annual fee credit card. That's where I'm getting a better advantage or benefit of using the credit card. I have a perfect example. Few months back, my iPhone got an issue with its speaker, where the speaker had stopped working, and it was 15 months since I got the iPhone, and the cost to replace the speaker was $450 plus tax. That what Apple Care told me, $450 plus tax. Now, because I had used my RBC Visa Infinite credit card, I was able to claim the insurance, because what RBC had offered to me, that if I pay for every dollar for iPhone using my RBC Visa Infinite credit card, they will extend the manufacturer warranty by 1 year. It's kind of an insurance. So I sent the bill or the code to the RBC, and they issued me a check for $450. So that $120 per year fee was paid off, or kind of covered by, because I had the insurance. There are some credit cards which have better advantage of using them, but the main advantage of using a credit card is you build a credit history here. Why you need a credit history? Because when you get to buy a home, you have to buy a new car, they're going to check your credit history. And let's say someone is new here in this country and don't have a credit history here, but still need to start from somewhere, yeah? They need a credit card for that purpose. There are different kind of credit cards too, like it could be unsecured, the most commonplace in today's market. Unsecured credit card, the secured credit card, small business credit card, or maybe someone is a student, or a student credit card. You can approach your bank where you have your checking or savings account to ask for a credit card, or you can get it from any place, yeah? You don't need to have a checking or savings account with a bank to get the credit card. But if someone is new and you need a credit card, you can go with a secured credit card. What it means, let's say you approach the bank but you don't have a credit history. The bank will ask you to deposit $500. It's just an example, it could be any amount in a savings account or other type of account, but you will not have any access to this $500. What they will give you or offer you, a credit card worth $500, which you can use for payments and pay back, because that's the limit. Use it, pay it, and then when you build a credit history, you can approach the same bank. Hey, after 6 months or maybe 1 year, or maybe they will offer you something, and then you can get to a unsecured credit card, or maybe a new bank or a new lender where you can get an unsecured credit card after a few months, after you have built up a history here. And you can just close this account and claim back your savings of $500. Not a bad choice to build a credit history. And there is one credit card by Canadian Tire. I'm not doing any I'm not. And there's one more credit card which I like, or I have just applied for it. Canadian Tire credit card, where you get free roadside assistance. Let's say in the harsh winter weather, you're stuck on a highway, you need to call CAA or other towing companies so that you get some help. If you have this free roadside assistance and you had this Canadian Tire MasterCard, you have to do your own search, what they will qualify you, and you can just call the roadside assistance. They will come and they will see the issue, like if it's a flat tire or it's a unique or your car needs a battery boost. Not a bad choice. And that credit card has no annual fee. I'm not telling you to apply for this credit card or RBC credit card, but before you get into anything, any kind of debt, because after all, a credit card is kind of a debt, you should consider all the options or benefits why you need this credit card. And why the different companies offer these credit cards? Because of the compound interest. Remember, credit card companies are not charging you simple interest, they are charging you compound interest. What is a compound interest? Let's say there was a leftover balance and you was not able to pay principal, the full amount or the partial amount that you have used for a particular month, and there's interest that will make up your new principal for the second month, P2. And let's say you're not able to pay full P2 amount in the next month, this new principal or the balance, let's say P3, there will be a new interest that will add up to your original or the leftover principal, and then there's your P4. So you are paying interest on interest. This is the same compound interest that's being used in India or particularly in Punjab to charge the farmers by the private lenders, and they are infinitely stuck in the cycle because they don't know, most of them don't know what they're getting into. They're getting into a compound interest where you pay interest on interest. It's not simple interest where you just pay the interest on the remaining principal. You're paying interest on interest, and that adds up a lot. So that's how the companies are making money from credit cards. So be careful and use due diligence before you get into any kind of debt or into credit card. Let's talk about second type of debt in detail, which is line of credit. There are different kind of line of credits which are offered by lender or by banks. It could be secured, where you put something as a collateral to get the line of credit, or it could be unsecured, that your bank can just offer you without securing any collateral, or it could be home equity line of credit, which is called HELOC, home equity line of credit. Let's say you have built up equity in your home, then the bank can offer you a line of credit based on the built equity, but there will always be some terms and conditions associated with the line of credit, for what purpose you can use it or you cannot use it. It could be student line of credit, that's another type of line of credit. And the line of credit interest rate is particularly lower than the credit card interest rate, which is normally prime plus a bank interest rate, what the bank can offer you. That becomes your final interest rate for your line of credit. And The line of credit interest rate is simple interest which is calculated daily. You're not getting any kind of 21 days like in credit card in your line of credit. As soon as you take out any money from your line of credit, you will be getting charged the interest rate, which is simple. It is still going to be lower than the credit card, and it should be before you buy a house, what I recommend my clients that they should get a line of credit, at least an unsecured line of credit. The lender might or might not ask you to close it before giving you any funds, but in most of the cases when it's first or second home, they will let you keep the unsecured line of credit. It's a very good backup just in case anything happens to you or your home, so that you have access to some funds immediately in addition to your savings. You can use that backup when it's needed. And let's say you have a 10,000 worth of line of credit, but you used only 5,000 out of it. You will be paying interest only on 5,000, not on 10,000. And it will be calculated daily, and it will be a simple rate of interest. And the third type of debt, it's the long-term financing. Let's say you need a car loan to buy a new car or a second-hand car or a used car, or you need a loan for you to buy a dining table or a couch from Leon's or Bad Boy or other furniture stores, or there's a hot water tank on rent. We can categorize them under the long-term financing. And because it's a debt, it's a kind of a debt, you should be careful what you're getting into, what are your new car payments are going to be, whether those are going to be in your budget. And fourth and the most important type, that's the mortgage. Because of the high prices of the home, almost everyone need a mortgage to buy a house. I will consider someone lucky if he don't have any mortgage on his house. So what is a mortgage? Basically, you put your house as a collateral with your bank or the lender, and you will be making monthly, bi-weekly or weekly payments to your lender to get your house free from the lender, so that you don't owe anything or any money to the lender. And your equity, when your equity gets 100%, then you can say that your house is mortgage free. There are different terms with the house. It could be 1 year term, 2 year term, 3 year term. It could be an open loan, or it could be a closed loan where you cannot repay more than what you had originally agreed, or it could be an open loan where you can make extra payments so that you can get your house free from the bank as soon as possible. And normally there will be an amortization depending upon your down payment, credit history, or other things. It could be 25 year to 30 year in Ontario. So that's the amount of time you will need to fully pay down your mortgage. Mortgages is just a very vast topic that I will need a full day video to explain everything in the mortgages. Even I don't know everything about the mortgages. There are some experts. Before you buy a house, make sure you have some kind of a surety or some kind of a yes from your mortgage broker or your bank before you put on any offer, so that there are less issues near the closing. Thank you. If you like my videos, please hit the like button, subscribe my channel, and share it with your friends and families. Thank you.